The world of trading. For as long as humans have needed to exchange goods, they've traded with each other. Be it through grain futures in ancient Mesopotamia in 2260 BC, or contracts on tulip bulb bubbles in Dutch Haarlem in the 17th century. What we think of as modern trading has a far shorter history. We take you through the major events over the last 150 years that transformed trading into what we know it as today. On October 29, 1929, Black Tuesday hit Wall Street as investors traded some 16 million shares on the New York Stock Exchange in a single day. Billions of dollars were lost, but not Joe Kennedy. He had sold his stocks off a day before the crash started. Legends say he made a decision shortly after a shoe shine boy tries to give him stock advice. Back then, the stock market was considered a place only for the rich and powerful. Kennedy thought if a shoe shine boy could be trading stocks, something must have gone wrong. Scared off by the 1929 market collapse and the Great Depression, it takes until 1954 for the Dow Jones Industrial Average to surpass its 1929 peak. Further limiting trading, most commissions were fixed, high, and non-negotiable. The first electronic stock market opens February 1971. The National Association of Securities Dealers opens the NASDAQ, the world's first electronic stock market. The system includes about 2,150 securities and reduces the cost of trading. The Vanguard launches Index Mutual Fund, August 1976. Vanguard rolls out the first S&P 500 index fund, putting itself at the forefront of what will become known as passive investing. Nowadays, everyone could trade the financial market. You don't have to have a vast fortune to do so. The market has been more accessible whenever, but that doesn't mean you should take trading lightly. We have different types of assets and contracts that can be traded, and they are all easily accessible. Popular trading instruments usually see high trading volumes daily. They include: Number 1, stocks. Number 2, exchange-traded funds. Number 3, futures contracts. Number 4, forward contracts. Number 5, options. Number 6, currency derivatives. Number 7, metals. Number 8, contract for differences. Our main journey focus in subsequent videos is currency derivatives. Currency derivatives are commonly used by Forex traders who trade based on currency fluctuations.